Last month I logged into my credit card account to pay my bill. Nothing unusual, just another routine moment. You check your balance, maybe wince a little and move on. But before I could even get to the payment screen, a pop-up took over the page. Update your annual income to help us serve you better. It looked harmless, friendly even. My old income was already filled in, and all I had to do was type in a new number, serve me better. That's what they said. And for a second it almost worked. It felt like something I was supposed to do, like updating your address, or confirming your phone number, normal, expected, responsible. But I didn't update it. I closed the pop-up, because I know exactly why they're asking for that number. And it has absolutely nothing to do with serving you better. Here's what most people don't realize. When you tell your bank how much you make, you're not just giving them information, you're giving them leverage. You're handing over a number that feeds directly into systems designed to decide how much money they can make from you. And once that number is in their system, it doesn't just sit there. It starts working against you. Every time you log in, every time you swipe your card, every time you carry a balance. That number is being used, not to help you, but to optimize you. Let me explain. Banks don't ask for your income because they need it. They ask because they want it. And that difference changes everything, because when something is required, you don't have a choice. But when something is requested and made to feel required, that's where people lose control without even realizing it. Think about how often you've been asked for your income. Credit card applications, loan forms, account updates, even random prompts when you're just trying to pay a bill. It's everywhere. And it's always framed the same way. This helps us serve you better. This helps us understand your needs. This helps us offer you the right products. Sounds helpful, but here's the twist. The more they understand you, the easier it is to profit from you. And that's where things start to get uncomfortable, because behind every one of those friendly forms, there's a system running calculations you'll never see. And those calculations are deciding things about your financial life that you assume are random, but aren't: your credit limit, your interest rate, the offers you see, the pressure you feel. It's all connected, and it all starts with one number: your income. But to understand how this really works, you need to see what happens the moment you give it to them. Because what looks like a simple update is actually the start of something much bigger. The moment you enter your income and hit submit, something changes. Not on the surface, your screen looks the same. Your account still works. Nothing feels different. But behind the scenes, your entire financial profile just got updated. And here's what most people don't realize. You're not just a customer to your bank, you're a data profile, a set of numbers, patterns, and probabilities that gets analyzed every single time you interact with their system. Your income becomes one of the most important inputs in that profile. Because income doesn't just tell them what you earn, it helps them estimate what you can tolerate. And that's where the shift happens. Because banks don't just measure risk, they measure opportunity. Let me explain what that means. When you think about credit cards, you probably assume the system is simple. Higher income means lower risk. Lower risk means better treatment. Lower interest rates. Better offers, more benefits. That's what most people believe. But here's the twist: banks aren't only trying to avoid losing money. They're trying to maximize how much they make from you. And those are two very different goals. So instead of asking, will this person default? They're also asking, how much can this person afford to pay? Without pushing back. And your income helps answer that question. Let's break this down in real terms. Imagine two people living in the US, both have a decent credit score. Let's say around 720. Both pay their bills on time. Both carry a balance occasionally. But one earns $60,000 a year. The other earns $150,000. Who do you think the bank sees as the better customer? Most people would say the higher earner, but not for the reason you think. It's not just about risk, it's about potential profit. Because someone earning $150,000 is more likely to carry larger balances, spend more consistently, accept higher annual fees, ignore small differences in interest rates. And that last one matters more than you think. If your interest rate is 18%, instead of 16%, that difference might not feel urgent. Especially if you're juggling rent, groceries, a $400 car payment, and maybe student loans on top of that. Life is already expensive, so you don't question it. And the system knows that this is where something called ability to pay pricing quietly comes into play. Banks don't just price based on risk. They price based on what they believe you'll accept. the more you can afford. The more flexible they become with what they charge you, not because you're riskier, but because they believe you won't fight it. And your income is one of the clearest signals they have. Now let's talk about something that feels like a benefit, but often isn't: credit limits. When your income goes up, your credit limit usually follows. On the surface, that sounds great. More spending power, more flexibility, more breathing room. But here's what most people don't realize. A higher limit doesn't just increase what you can spend. It increases what you probably will spend. Because once that number is there, it becomes normal. A $5,000 limit feels restrictive. A $25,000 limit feels comfortable. And slowly, without noticing, your spending expands to match that comfort. Maybe it's a slightly nicer apartment. Maybe it's eating out more often. Maybe it's putting a $1,200 emergency on your card because you don't have savings. And now you're carrying a balance you didn't plan for, at 20% interest. And that's where the bank makes its money. Because the goal was never just to give you access. It was to increase your exposure, to give you more rope. Because statistically, people with more rope tend to use it. And once they do, the system starts working exactly as designed. But that's only one part of it. Because once your income is in their system, something else begins to happen. You start getting treated differently. Not in ways you can easily see, but in ways you will definitely feel. And it shows up every time you open your app or check your mailbox, or get one of those exclusive offers that somehow feel a little too targeted because now you've been categorized. And once that happens, you're no longer just using the system. The system is actively working on you. And what it does next is where things get even more interesting. Once you've been categorized, everything you see starts to change. Not all at once, not in a way that feels obvious. But gradually, consistently, your account stops being neutral and starts becoming personalized. Now, that might sound like a good thing: personalized offers, better recommendations, more relevant options. That's how it's framed. But here's what most people don't realize. Personalized doesn't mean better for you, it means more effective for them. Because now that your income is on file, the system knows exactly how to approach you. If you're a higher earner, you'll start seeing offers that match that profile. Premium credit cards with $550 annual fees. Exclusive travel rewards programs. Pre-approved personal loans with large limits, investment products. Insurance add-ons, upgrades. Every time you log in, there's something new, and it's all positioned the same way: opportunity, convenience, upgrade your lifestyle. But here's the twist. Each one of those offers is calibrated not randomly, but specifically for your income bracket. Because the system isn't just asking, will this person accept? It's asking, what version of this offer is most likely to get a yes? And your income answers that. Now let's flip the perspective. If your income is lower, the offers don't disappear. They just change. Instead of premium cards, you might see balance transfer promotions. Instead of travel perks, you'll see low monthly payment loans. Instead of upgrades, you'll see relief. But here's the uncomfortable truth. Those offers are just as strategic, because when someone is financially stretched, the system shifts from maximizing upside to exploiting pressure. 0% balance transfers that quietly include fees. Personal loans that consolidate debt, but extend it. Credit limit increases that feel like relief, but lead to more spending. Different strategy. Same objective: extract as much value as possible from the relationship. And your income plays a central role in deciding which version of that strategy you get. Now here's something even more important. That number you gave them, it doesn't expire, it stays in your file for years. And it continues to influence decisions long after you've forgotten about it. Whether your limit gets increased, whether your rate gets adjusted, whether your account gets flagged during an economic downturn, all of it can be influenced by that one number. Because banks don't think in moments, they think in timelines. They're not just asking, what can we earn from this person today? They're asking, what is this person worth over the next 5, 10, even 15 years? That's called your lifetime value. And income is one of the biggest inputs in that calculation. The higher your perceived value, the more aggressively they try to optimize you. And here's where things start to get uncomfortable. Because while they're building a detailed picture of you, you have almost no visibility into how that picture is being used. You don't see the models. You don't see the categories. You don't see the triggers that decide what you're shown or what you're charged. All you see is the result. And most of the time it feels normal. That's what makes it so effective. Now let's talk about something that clears up a lot of confusion. When are you actually required to tell them your income? Because this is where most people get it wrong. There are situations in the US where income disclosure is legitimately required. If you're applying for a mortgage, for example, lenders need to verify your income. They'll look at your tax returns, your W-2S, maybe even your pay stubs. That's because of regulations designed to prevent reckless lending. Same thing with many auto loans, especially if you're borrowing a large amount. They need to confirm you can repay. That makes sense. But here's what most people don't realize. Credit cards are different. When you apply, they'll ask for your income. But in most cases, they don't actually verify it. They can't just pull your IRS records without permission. They're relying on what you tell them. And those update requests you see later, the ones that pop up when you log in, those are completely optional. There's no law requiring you to keep that number updated, no penalty for ignoring it, no consequence for closing the pop-up and moving on. They want the information, they don't need it. And that distinction matters more than people think. Because once you understand that, you start to realize something. You have more control than you've been led to believe. But before we go any further, let me be absolutely clear about one thing. Because this is important. And if it's misunderstood, everything else falls apart. I'm not telling you to lie about your income, not on an application. Not anywhere. That crosses a line. It's illegal, and it can come back to hurt you in ways that aren't worth it. That's not the point here. The point is understanding the difference between lying and not volunteering extra information. Those are two completely different things. If a lender is legally required to verify your income, you provide it simple. But when a bank sends you a pop-up asking you to update your income to serve you better, you have a choice. And most people don't realize that. Because the design of those requests makes it feel mandatory. The wording feels official. The timing feels urgent. The form looks like something you're supposed to complete. So people comply automatically. Not because they have to, but because it feels like they do. And that's where control quietly slips away. Now let's talk about what this really comes down to. Because underneath all of this, there's a deeper frustration most people are dealing with. You work, you earn, you try to stay on top of bills, you pay your credit cards, and yet somehow it still feels like you're not getting ahead. Like no matter how much you earn, something is always pulling you back. That's the real issue. That's the primary complaint. I'm doing everything right, but I still feel financially stuck, and part of that feeling comes from not understanding how the system is actually working around you. Because when decisions are being made about you, using information you gave freely, without fully understanding the consequences, it creates a gap between what you think is happening and what's actually happening, and that gap is expensive. So what's the solution? It's not extreme, it's not complicated. It's awareness and control. You don't need to fight the system. You just need to stop feeding it unnecessary data. Let your behavior speak instead. Pay on time, keep your balances low, build your credit score through consistency. Those are the signals that actually matter. Not a number you type into a box once a year. Because behavior is harder to manipulate and harder to use against you. Now let me show you how this plays out in a real situation. Imagine two people, both living in the US, both earning a decent income. Both using credit cards regularly. The first person updates their income every time the bank asks. Their salary goes from $70,000 to $95,000 over a few years. Each time they update it, the system recalibrates new offers, higher limits. More aggressive marketing, more pressure. The second person doesn't update anything after the initial application. They ignore the pop-ups, close the requests, leave the number as it is. Same spending habits. Same payment history, but a completely different experience. Fewer targeted offers, less pressure, more stability. Which one is better? That depends on what you want. If you want access to more credit, more offers, more options, then sharing more data might benefit you. But if you want simplicity, if you want less noise, if you want to avoid being constantly pushed into spending decisions, then giving less information can actually work in your favor. Because the less the system knows, the less it can optimize against you. Now let me tell you something that makes this even clearer. A friend of mine learned this the hard way. She's a freelancer. Her income fluctuates. Some months she makes $8,000. Other months it's closer to $14,000. When she first got her credit card, she reported a conservative number, something stable, nothing exaggerated. A couple years later, she got one of those income update prompts. She figured, why not? Her income had increased, so she entered a higher number. Within a few months, everything changed. Her inbox started filling with pre-approved offers, personal loans, premium credit cards, balance transfer deals, even investment products she never asked about. Her credit limit increased without her requesting it. And suddenly every interaction with her bank felt like a sales pitch. Nothing broke. Nothing went wrong. But everything felt heavier. More pressure, more noise, more temptation. So she stopped. The next time the pop-up appeared, she closed it. And the next time. And the next, and within a few months, things settled down. The offers slowed. The pressure dropped. Her account went back to feeling normal. That's not a coincidence. That's how the system works. It thrives on fresh data. The more recent your information, the more aggressively it can act. But when the data gets old, the system loses confidence. And when confidence drops, so does the intensity. That's why they keep asking. That's why the pop-ups don't stop. They're not trying to help you. They're trying to refresh your profile. Because every update gives them a clearer picture of how to approach you. And the clearer that picture, the easier it is to make money from you. Now here's where it all comes together. Because once you understand this, you start to see a pattern, not just with banks but with almost every institution you interact with. They ask for data, they frame it as helpful. They normalize the request, and then they use it to optimize their outcome, not yours. So the real shift isn't just about income, it's about how you respond to these requests moving forward. Because every time you're asked for information, there's a simple question you should be asking yourself. Who does this actually benefit? And if the answer isn't clearly you, then you already know what to do. But there's still one piece left, because knowing this is one thing, applying it in real life is another. And that's where most people still get it wrong. So let's make this practical. Let's talk about exactly what you should do, and what you should stop doing, and what you should stop doing starting today. So let's make this practical, because understanding the system is one thing, but knowing how to move inside it without hurting yourself, that's what actually changes your financial life. Start with this. When you apply for a credit card in the US, you will be asked for your income. At that point, you provide it. That's part of the approval process. But here's what most people don't think about. You don't need to present your absolute peak income. If you have bonuses, side gigs, or irregular earnings, you can report a reasonable, stable figure that reflects consistency. Not your highest possible month. Accurate but not inflated. Because once that number goes in, it becomes part of how you're evaluated moving forward. Now, after you're approved, everything changes. Those pop-ups asking you to update your income, you can ignore them, close them, skip them. There is no penalty. Your credit score won't drop. Your account won't be shut down. Nothing negative happens. The bank just doesn't get the fresh data it wants. And that's the key. You're not breaking any rules. You're simply choosing not to give optional information. Now let's talk about credit limit increases. Because this is where people get pulled in. You log in and see a message. You're eligible for a higher credit limit. It feels like progress, like you're moving forward financially. But pause for a second, ask yourself, do you actually need more credit? If your current limit already covers your expenses, if you're trying to stay disciplined, if you're working to pay down balances, then a higher limit doesn't help you. It increases temptation, it increases exposure. And in many cases, it increases how much interest you'll pay over time. So if you don't need it, don't request it. And if they ask for updated income to process it, that's your signal. Because now you understand the trade-off. You're not just getting a higher limit. You're giving them more data to work with. Now let's bring this into real life. Think about someone living in Los Angeles. Rent is $2,200. Car payment is $450. Groceries are up. Gas is unpredictable. Maybe there's a $300 student loan payment sitting in the background. And then something happens. A $1,000 emergency car repair, medical bill, unexpected expense. It goes on the credit card. Now there's a balance, interest starts building. And over time that balance grows faster than expected. This is where the system makes its money. Not in one big moment but in small, consistent increments. And if that same person has a higher credit limit, they have more room to keep spending, more room to delay the problem, more room to carry debt longer. That's not support. That's exposure. Now let's talk about something subtle but important: phone calls. Sometimes your bank will call and say they're viewing your account. They might ask to confirm your income, update your details. Make sure everything is accurate. It sounds routine, but remember what you've learned. If it's not tied to a required process, you can decline politely. Simply. You don't need to explain yourself. You don't need to justify it. I'm not interested in updating that right now. That's enough, and the call ends. Nothing happens. Your account continues as normal. Because again, they want the data, they don't need it. Now zoom out for a second. Because this isn't just about one bank or one credit card. This is about how you interact with systems that are built to extract value. Every piece of data you give, every form you fill, every quick update you complete, feeds into something: a model, a profile, a prediction about how you behave. And the more accurate that prediction becomes, the easier it is to influence your decisions. That's why data matters. That's why small things like income updates matter more than they seem. Because they sharpen the system's ability to work on you. So what's the strategy? It's simple. Give what's required, hold back what's optional. Be intentional, not reactive. Because most people aren't making financial decisions. They're responding to prompts, forms, notifications, offers. And over time, those small responses add up. Now imagine flipping that. Instead of reacting automatically, you pause, you ask one question: does this help me or help them? And if the answer isn't clearly you skip it. That one shift changes everything. Because now you're not just participating in the system, you're navigating it. And once you start doing that consistently, something interesting happens. You feel less pressure, less noise, fewer distractions pulling you into decisions you didn't plan to make. Your financial life becomes quieter, more stable, more intentional. And that's where real progress starts. Not from chasing more offers, not from increasing limits, not from constantly updating information, but from controlling what you give and why you give it. And once you see it this way, you can't unsee it. Because the next time that pop-up appears, the next time your phone rings, the next time you're asked to update your information, you'll know exactly what's happening. And you'll have a choice, a real one. So before you click anything, before you type anything, just stop for a second. And remember this: the system doesn't need more data from you to work. It already has enough. The only question is, how much more are you willing to give it? If this opened your eyes even a little, then you already know what to do next. Pay attention to those small moments. They matter more than they seem. And if you want more breakdowns like this, simple, clear, and actually useful, make sure you like this video and subscribe, because once you start understanding how these systems really work, you stop playing the game blindly, and you start playing it on your terms.